employee benefit IAS 19. So technically IAS 19 employee benefit, we covered certain part of this related to the employee benefit, like what we have actually keep on mentioned in lower level financial accounting papers, such as the salaries, wages, and all those things like commissions. Okay, so all these are quite classic example whereby we just debit expenses under operating categories and credit our accruals or bank. So this is so called as short terms employee benefit. So this is quite straightforward, and certain example could be quite difficult. Is like our profit sharing bonus or certain things like that. So we must ensure that we have a present obligations and the amount can be measured reliable. Okay, present obligation as a result of past event. Then we should recognize the provisions accordingly, debit expenses and credit our provisions. The start cost, credit provisions. So this is what we mean. And also some unutilized annual leave by the employee, like at the end of the year, financial year end, let's say the accumulated leave that from all the employees is like 100 days, okay, and averagely we should have a working to tag with each different employee daily salary, but just assume that at the end of financial year end, approximately everyone got their unutilized annual leave and we times with their each of their daily wages, so we will get like 12,500 example. So this unutilized annual leave, we also need to do an adjustment like debit our staff expenses, like maybe unutilized expenses on the unutilized annual leave, and we will need to credit the provisions for unutilized annual leave. So until next year, we are going to reverse back. The reason being we need to make the provisions is because of this unutilized annual leave, is because when the employee they carry all this leave to the another year, right? So if suddenly in another year they resign, we will need to have a cash outflow on paying all these obligations. Therefore, technically, on the date of 31st December of each year or each financial reporting of the entities, right, if the employee having this unutilized annual leave, we are going to make a provisions, because technically we are having a present obligations to pay this annual leave in cash, because we have the responsible to do that. Therefore, there is a provisions and we need to recognize the expenses. The second part of this IAS 19 talk about your post-employee benefits. And post-employee benefit, the first part will be defined contributions benefits. So this defined contribution benefit is like by law we will need to give this much of contributions and put it under the government investment funds. Like in Malaysia, we call it as KWSP, EPF. Like for example, your EPF employer portions, example, employer need to contribute 13%, 12% example. So from the particular employee, for example, 5,000 he's earning, we will need to debit our EPF expenses. So this is our employee benefit that we paid out as an extra benefit, and we will need to credit accruals if let's say we are paying in the next month. Okay, so we will debit 5,000 and credit 5,000. So once we paid out, okay, we already done with our obligations, and the particular investment fund will help to manage the particular employee's EPF account. So they will invest and they will give return to the employee in their respective account. So this is defined contribution benefit. And the one that we are focusing today will be on the defined benefit plan. Okay, defined benefit plan. So this defined benefit plan, right, is actually so-called the pensions fund. Okay, so this pensions fund will be set up by the entities voluntarily to their employees. And once on a date they promise the employee that they are going to give this fund to the employee when they pensions, we will actually have a present obligations. So these present obligations in the form of the promises, in the form of pensions, we will need to discount back into present value. Okay, in the form of present value of the pension liability. And for a good governance purpose, we will need to set up a plan asset. Okay, this plan asset we are going to set up anytime when there's a staff retired, right? They want to get this retired fund, we can actually pay out from this plan asset. Therefore, there will be always setting up a present obligations and asset, and we will need to calculate the movement. So each of the liability and asset, we will look at their movement, and then any differences in terms of their valuations, we will charge to our OCI. And there are respective entry that I would like to show you in a short while. ARIA operates a defined benefit plan for its employee at 1st September 2025. So this is going to be our starting, and our year end is on 31st August 2026. And the fair value of the pension plan asset, so meaning to say at the beginning our plan asset we have 2.2 million. So the 2.2 million, as you can see over the right hand side of my screen, I put it under my plan asset. And subsequently, the following line, they mention about the present value of the plan liability. So meaning to say, our plan liability is 1.8 million. So this is going to be our starting up. So I mentioned already, we must have promised, then this asset is to pay off this promise. So subsequently, we actually have the actuarial estimate that the current service cost is 31st August 2026 is 620. So meaning to say, during the year, regarding to the pensions fund that happened in the future value, we discount back, we know that currently the service cost that we promised to our employee is 620. And this current service cost is like your promise in this year, which will increase your liability. So we are going to put it under our liability as current year service cost. Please take note that the current year service cost is happened at the end of the year. So it won't impact on your interest calculations, because just now our operating defined obligations is all a present value. Discount back from future value to present value. So we will need to move from the present value back to the futures. We will need to unwind interest. So as you can see over here, we always have unwind interest in your calculations related to your plan asset and defined benefit obligations. So sometimes the question might tell you all these past service costs or current service costs may be paid before the interest charge or whatever. So technically this current year service cost, we will put it under here. It won't touch our interest. And the interest rate on high quality bond, always use high quality bond, which is for 31st August 2025, meaning to say at the beginning of the year is 5%. So we continue read first, because sometimes the past service cost could be happen before the interest, meaning to say happen at the beginning of the year. So interest we always charge at the beginning of the year. Therefore, we need to take care of this one. And the pension plan paid 310 to retired members on the last date of the year. So we paid the pensions. So when we paid, liability reduced, and we paid, our asset will reduce, because we use the asset money to pay the liability. And please remember that when here pay out, net, when we look at the net asset, the effect is zero. Okay? On the same date, ARIAS paid 550 as contributions, of which 140 is the past service cost. So nothing to do, you don't need to minus, because when ARIA, the company, contribute 550, the contribute will increase the plan, meaning to say when you have promised, you need to make sure you also contribute to the money to the plan asset, right? So they continue 550, and at the same times, 140,000 is actually your past service cost. So you increase and then your past service cost also paid on the same date, which is 31st August 2026. So at the end of the year, it won't touch your interest. Therefore, your past service cost is 55000. Your past service cost is 140,000. And with that, we can calculate our interest, because the last sentences will be on your fair value of your pensions plan at the end and at the end of the liability. So 1.8 million times your 5% quality bond and 2,200, 2.2 million times your quality bond, 5%. So times 5%, 90,000 and 110,000. And therefore, we will need to put on our closing defined obligation and closing plan asset. So in 31st August 2026, the fair value of plan asset is 2.5 million. And the present value of the plan liability is 2 million. Sorry, this is 2 million. And this is 2.5 million. And we will need to look at whether our asset is increased or decreased. So looking at this example, your liability, if we sum up at the end of the year, is 2.340. So valuer said, the actuary said the value is actually worth 2 million present value of liability. So there is a decrease in liability, which is known as a gain on remeasurement. Positive liability, there's a reductions. So in this case, gain on remeasurements. So when your liability reduce, it's a gain on remeasurement. If your liability increase, it's a loss of remeasurement. For plan asset, your asset until the year end is 2.55 million, and your asset value by the expert is 2.5. So your asset value reduce. So asset value reduce is actually your loss of remeasurement. Okay, when asset value increase, it's a gain on remeasurement. So if you provide the notes to profit or loss, right? So your current service cost, you are going to debit your expenses, credit your liability. That's why your liability increase. And your past service cost, debit your expenses, credit your liability as well. And the net of interest, you have interest, this is your income, this is your expenses. Income, you debit debit asset increase, income, credit. Expenses, you debit expenses, credit your liability also increase. So the net of it, our income more than expenses. So there will be a positive 10,000. So this will be our notes to statement of profit or loss. So every single things that we see in here will impact your SOPL. But benefit pay, it won't, because you will debit your liability and credit your plan asset, because you use the plan asset to pay the liability. So these two won't touch your SOPL. Likewise, this already record in here, and the contributions, you will debit asset, credit your bank. Bank will go down. And lastly, you have your gain or loss of remeasurement of liability and asset. So our gain on remeasurement liability and our loss of remeasurement of asset. So our net of it is 209,000. So at the end of the year, our notes to financial positions, your present value of pension opening is 1.8, asset is 2.2, so the net asset is 400, and at the end, your pension liability 2 million, pension asset 2.5. So the difference will be your net asset. So this is gonna be the presentations of your financial statement, and also how we calculate the defined obligations and asset. So if question asks you about discussed with reference to IAS 19, employee benefit. What is the accounting treatments if your present value of future refund and reductions of future contribution means asset ceiling? Technically, is your recoverable amount of your net asset of your planned asset minus your obligations. So if they tell you that you have a recoverable amount of 400,000, according to IAS 19, your asset ceiling amount shouldn't be, your carrying amount shouldn't be greater than your asset ceiling amount. So our asset ceiling amount now is 400. According to our answer here, at the end of the year is 500,000. So under IAS 19, our amount must be limited to lowest of surplus of defined benefit asset and ceiling, which is 500, against the asset ceiling. So therefore, our net asset here clearly is 500k, and our asset ceiling is 400,000. So we will need to bring down our carrying value 500 to 400,000. So ARIA can only recognize 400,000 in their SOFP rather than 500, which is in here. And therefore, that 100 reductions will be recorded as your OCI, okay, which is an adjustment related to your asset ceiling. So the 100 adjustment arising from asset ceiling represent remeasurements of net defined benefit asset should be recognized in OCI as the asset ceiling adjustment. So meaning to say, your net amount, net asset, if your asset is more than liability, there's a net amount in your SOFP calculations, you must assess again your asset ceiling, which is the recoverable amount. If it's greater than that, then you should bring down equals to asset ceiling. The amount is like your impairment. You should go into OCI, but not expenses under SOPL. That's it, a simple recap of IAS 19. I hope you learned something from this video. Thank you.